This is how people like Grant Cardone, Robert Kiyosaki, and Donald Trump can pay no taxes on their business income by utilizing their real estate with cost segregations. Hey, my name's Matt, and I'm a CPA, and I run a firm called TrueBooks. We specialize in real estate taxation and real estate investing and how to utilize that to your best advantage when it comes to your taxes. I myself am a real estate investor, so I can sit in your shoes and understand what it's like to not only run my rental properties, but also utilize them to my best advantage, which is what? Growing my wealth, but also maximizing my tax position. And so today we're going to talk about cost segregation, which is huge in the real estate community when it comes to taxes. All right, so there's a million things that we can cover when it comes to cost segregation. And so I'm going to try to keep myself on pace here and stick to the most important topics, because this can get way off topic and we can go down every rabbit hole possible. But leave that for the comment section and be sure to drop any comments or questions that you want me to address, maybe in a later video, or we'll do maybe a live call to address them. First, what is cost segregation? Cost segregation is exactly what it sounds like. I am segregating costs of a specific asset. In this example and for the video, we're going to talk about like a single family house, something that you would typically buy to either live in or own as a rental property. And the point of cost segregation is, if you think about it, when you buy a property like a rental property, you did not only buy the house, but you also bought the land, you also bought the lights, the carpet, the furniture, the fixtures, the cabinetry, and everything inside of that property as well. And when it comes to taxes, we don't want to just say that you spent $500,000 on this one house. We want to say you spent $150,000 on the land. You spent $150,000 on the interior assets, like the cabinetry, the furniture, the fixtures, and then you spent $200,000 on the entire building and the shell itself. And you see how what we did there at a small scale was cost segregate the entire purchase price of that rental property. And that is what a cost segregation study is going to do. And this will make more sense later as to why we would want to do that. Because if you think about it at surface level, cool, we spent $500,000 for this property that we now own as a rental property. But you'll see come tax time, it's very important that we identify what assets within that property that you bought are valued at what amounts. So let's talk about who does a cost segregation study. I am a fan of going to a cost segregation firm, period, which is typically a team of engineers. There are CPA firms. I am a CPA myself. I run a CPA firm. We do not offer cost segregation. I have close friends that run cost segregations out of their CPA firm. We will get into the types of cost segregation reports that are possible. But if you ask me, I am all about going to a firm that only does cost segregation. That is their main business to run, because I know I'm hiring a team of experts that's what they do. They're not doing taxes and accounting and bookkeeping and also cost segregation on the side, because when we get into the types of reports, they're not giving you the ultimate gold standard of a cost segregation report. And we'll get into that later. So if you ask me who does them, I would go to a firm that does cost segregation. We can actually link a couple of those of who we work with. Feel free to use them, reach out to anybody that you want to, but we use firms that specialize in cost segregation. And that would be my recommendation if you were looking to do one yourself. With a small caveat being, if you have a CPA that is offering to do a cost segregation for you, I'm not saying to run for the hills. I'm just saying expect that the report will not be that gold standard type, which we'll talk about later, and that there's more room for error, being that this is not their main line of business. Their main line of business is likely to do taxes and accounting. All right, so we talked about who does it. Now let's talk about who needs it. Who needs a cost segregation study? Well, first, no one really needs it, but you would want to get one if you're on the path towards the goal of saving money on your taxes or paying no tax on your rental income. And who needs it are rental property owners, people that own real estate for a profit, we will say. But let's say that I'm a flipper and I buy and sell properties and I rehab them and I do that for a living. I don't need to run cost segregation studies on properties that I'm holding to ultimately flip, because those are not investment properties. Think of those as milk at a grocery store. I'm buying something as inventory, I'm fixing it up and maybe, repackaging it a little bit differently, and then I'm selling it later on. A cost segregation study is specifically for real estate that you are holding as an investment. So if I'm a small-time investor, I own a couple single-family homes, maybe a couple triplexes, duplexes, things like that, to somebody that owns commercial buildings and casinos and large properties like that. From big to small, all of them can use cost segregation, but remember, these are properties that are being held for investment, not for ultimately to sell and flip. Now, even if I'm buying a rental property to mainly hold for the next 5 or 10 years and I know I'll sell it later, I would still get a cost segregation study. So the differentiating factor there is, if I'm buying it with the intention of never using it as an investment property, like a rental property, I'm not going to do a cost segregation. If I'm buying it as a rental property, then I very much would likely get one. And so to give a general rule of thumb of who should get a cost segregation study, I would look at it as, if you own a rental property where the cost was at least $150,000, you likely should get a cost segregation study. I'll explain why later. And also, if you have a rental property that is producing you net income, so rental income that you collect from your tenants after your mortgage interest, after your property taxes, after your commissions, after all of your expenses, and you're making a profit, I would likely get a cost segregation study as well, because it'll ultimately help you eat away at those profits and pay no tax on the cash flow that you're making from your rental, which is the goal. All right, so we talked about who does it, who needs it, why do you need it? And I have a quick answer here, and this is because there's not a lot to this. You ultimately need this cost segregation study in the event that you are flagged for audit by the IRS. This is because by doing a cost segregation study, you are getting a large amount of depreciation expense. So when you buy an asset, whether it's a car or a house, when you buy a house, you can depreciate a piece of that house, meaning a piece of that cost. And a cost segregation study allows us to write off, instead of this much. And the IRS thinks, hey, how are you taking such a large expense on this property? Well, if they come around asking, the cost segregation report is exactly what I would show them, because this is the support for why we're taking such a large deduction. It's simply breaking down the value, saying, hey, look at these assets. This is the value. This is what they paid for it. This is why we are able and allowed to take this kind of deduction. So if you think about it, the IRS, their systems, or someone manually is looking through a tax return and they see a large expense. If they question it, you want to have some supporting documentation as to why. You can't just say it was an estimate that I put together. All right, so talked about the who, talked about the why. Now let's talk about quickly the when. One of the biggest misconceptions with cost segregation studies is, do I need to do them in the year in which I bought the property or placed the property in service? And that answer is no. You watching this video now could have rental properties that you bought 4 years ago that you can now do cost segregation studies on and basically catch up on depreciation expenses that you should have taken previously. So don't think that you're too late to doing a cost segregation study if you already own rental properties and haven't done it yet. Now, when you talk about when you should do them, I typically recommend that people do a cost segregation study in the year in which they purchase the property or in the year in which they rehab the property, and once the rehab is done. All right, now we covered some of the basics of cost segregation. Now let's talk about the types of cost segregation reports. So earlier I had mentioned that there's multiple types of reports or types of cost segregations that you can do. And I want to really highlight 2 of them, because when you go to these firms to get a cost segregation, most of the time you're going to have 2 options when it comes to purchasing these services. So we talked about the general stats of a cost segregation study, but now let's talk about the types. And when we talk about types, the reason I'm breaking it down into 2 types, but there's really 6 different variations of types of cost segregation studies you can do. But when you go to a firm to get a cost segregation study, you're likely going to be posed with the option of what kind, and it's going to be 2 options. You're going to have a modeling approach, which is basically like an estimated approach, or you're going to have an engineering-based approach. And you can probably guess which one the IRS is going to like and which one you would rather walk into an IRS audit with. It's the engineering approach, because when you look at the modeling approach, this is taking similar properties into account and basically factoring into the estimates of what a similar project would cost. It's not looking at the actual cost of the interior assets or the actual design and build of those assets. It's taking a reasonable approach. And that's why we say a modeling approach. An engineering-based study is somebody coming out, visiting the property, most of the time in person, but they also can do virtual walkthroughs, but actually physically inspecting the property to determine, and this is typically an engineer, what these assets should cost based on the actual condition of those assets. So for example, again, furniture, fixtures, the interiors of the property. So you could see how already when you look at the 2, There's going to be some differences in cost. There's going to be some differences in input between the firm that helps you versus the taxpayer themselves. And so we'll get into that. But when you look at the two types, I really want you to remember that there is more of a, we call it a DIY approach and that modeling estimate approach, or a fully engineered study. And you can tell we point our clients to doing fully engineering based studies, but there is a time and a place for a modeling approach. And for me, it's typically on a lower valued property, one with less risk. When I say less risk, lower valued properties, lower cost properties are going to give you a smaller amount of depreciation expense. Larger properties, $1 million properties, you're going to have huge expenses that you're taking on the return, which could potentially trigger red flags. And so if they do, I'd rather have that fully engineered report to show the IRS as to why versus something of more of an estimate or a DIY where the taxpayer kind of did it themselves with a software. And so those are the main differences when we talk about the types of cost segregation reports. So in summary, if I look at the modeling approach, this is going to cost the client less money. It's going to be more work for the client because they're going to have to tell this software, tell the company what kind of assets are in the property. They're going to have to take their own pictures potentially, that kind of stuff. And I think it's going to carry less weight in an audit. A fully engineered report is going to cost you more money. It's going to be less of your time because now the firm is going to do most of that work for you. They're going to go out to the property for you most of the time. And it's also going to hold more weight in an audit, which also as a CPA makes me feel more comfortable and should make the client more comfortable as well. So now I actually want to walk through a report so you can see exactly how these are structured and if you ever are going to do one, what to expect when you ultimately get yours back. But one thing I always tell clients is there's really not much for you to do with them once the firm gives it to you. You simply send it over to your accountant, we keep a copy of it, and the hard work is on us from here for just reporting this information accurately on your tax return. You ultimately just want to save this in a file. Your accountant will as well. So ultimately you hope to never use it, but if you do, you have it. It's one of those things where you'd rather have it and not need it than need it and not have it kind of thing. All right, so this is a table of contents, obviously, for how this report is broken down. This is a fully engineered report. So as you can see, we're looking at a table of contents. I've had the firm that we work with be kind enough to send me a sample report. And you'll see here that here are the main sections. We have an executive summary. We have the actual cost seg report and calculations. That's the juicy components to it. We have the list of improvements by item. So if you buy a property and then end up improving that property and spending more money on it, we also want to make sure that we account for those as well. Asset classification, property description, the right photographs like we mentioned earlier, study purpose, procedure, and you'll see there methodology, the methodology behind, right, how these reports are being put together, stuff that the IRS would more so question in the event of, hey, you did a cost segregation, but what methodology did you use? Back to that whole sort of sampling and estimate approach versus, a fully engineered study. Normal legal jargon, some definitions and legal support, and then some general assumptions at the bottom. So let's actually jump to the cost segregation report and calculations. All right, and so here's an example of the cost segregation report and calculations. So you'll see this is a single family home. This is a, little over 3,000 square feet. It was purchased for $432,000. You'll see that we have a land allocation. Very important, right, that we break out the value of land when we buy something. That was $201,000, leaving the remaining cost, right, if we back out land, that is what's left of the building to be evaluated. And in this year, you'll see it was for 2023, which was a 80% bonus depreciation year. Now we are in a 60% bonus depreciation year being in 2024. And that will go down to 40 next year. So ultimately, right, we care a lot about what bonus depreciation rates are right now because they're directly correlated to when and why maybe we would do a cost segregation report or study on a property. And now in the middle section, this is the meat and potatoes of this. You'll see here that we have these buckets, 5, 7, 15, and 39-year property for depreciable basis. And this is because what we've done is we've taken that value of the building and we've broken it down amongst those 4 components. Because it's important that we know what assets have a life of less than 20 years, because those are the assets we can bonus depreciate, therefore leading to a major expense in year 1. That's the whole goal here. And so imagine if we did not do a cost segregation study. Back to this number up here. Once we back out land, you would simply be left with $230,000, and you would have to divide that by 39 years. But since we were able to break these components out, we now have 5, 7, and 15-year property. And look at the values that they've come up with here. 45,000, 0 of the 7-year, 31,000 of the 15-year, and then the 153 is the remaining 39-year. And remember, assets that have a life of less than 20 years we're able to likely bonus depreciate. And so that's the goal. We want to take that depreciation faster. And so while this is really the summary of the study, if we come down here, you'll see that there is a graph that kind of breaks down, right, the different allocations of value to the different types of assets in the property. And then if you come down here, you have actual photos of the property that will break down what it is inside that property. Again, in the event that somebody like the IRS is questioning how you came to these values. And next, here we have the methodology. And the only thing I really want to highlight here is you'll see there that it says our methodology follows professional engineering and cost estimating procedures, making sure that this firm is in line with the rules that the IRS would like them to be in to make sure that they're being fair in the estimates and that they have the actual expertise and experience to do this. You know, this is where I get concerned if there's a CPA out there offering to do cost seg studies for people, especially not being clear with them saying that, hey, I'm just going to use a DIY software, but I'll do it for you. Sure, you can do that, but that'd be almost, the same or a little bit better than just the client going in and doing it themselves. It's when the client thinks that they're maybe getting a better deal or a better type of cost segregation study from that CPA, when in reality, that CPA likely can't offer a fully engineering-based study unless they have engineers on staff or have the experience doing it. So that's just kind of my tidbit to you, or my tip. So now that we've walked through the report, I hope that kind of gives you a sense as to what you can expect when you see the report. But again, ultimately, when you get this back, you hope to never use it. Send it off to your accountant, we'll do what we need with it, and then we kind of put it in our file, hoping to never have to use it against the IRS. Now, with all of this said, cost segregations, what are they? It's us getting a larger amount of depreciation. I want to give you an example as to what exactly this looks like in practice and what it actually does to your tax return. So this is an example of a profit and loss statement for a rental property. An example. $19,000 you'll see of income, some advertising, cleaning and maintenance, and we come down here to a total loss of $56,000, right? Negative net income, a taxable paper loss. But you'll notice there that sure, we lost $56,000 on paper, but what happens if you back out and remove that depreciation expense of $60,000? You'll see that this property would cash flow about $3,900, which is great. That's a good property, right? To make $3,900 on a rental activity for the year. But again, so I'm cash flowing in real life, but I'm losing money on paper. And that is the ultimate goal, is because with this large depreciation expense number of 60 grand right here, it therefore swings me to a huge loss. Without a cost segregation, I likely would have got, let's say, 10 grand of depreciation, because remember, I would have taken the one number at my building value and just divided it by 27 and a half years if it was just a long-term rental, 39 years if it was a short-term rental. So you can see that that amount would be a lot lower than if I was to go in and say, hey, well, let's make sure that we identify through a cost segregation report what the smaller assets are worth. And let's say that they're worth 100 grand and we get bonus depreciation on those. And let's say last year we were in an 80% bonus depreciation environment. That's an $80,000 deduction versus what would be normally, let's say 10 grand. Again, for dramatic example, but it shows you that you're getting such a large amount of expense, which therefore brings you to a loss on paper. And that's the importance of this. It allows us to lose money on paper while cash flow in real life. And since I like to talk taxes about real estate and being a real estate CPA, that is a lot of the strategies that we focus on. At the end of the day, your goal, if you are a business owner and you like to go into real estate, your goal should be to make a ton of money over here on the business, make a ton of money over here on the real estate, but lose money on paper through cost segregation studies. And ultimately, if I can make $1 million in my business and lose $500,000 from my rental properties and my real estate portfolio, is to ultimately net those two together to only pay tax on $500,000 instead of $1 million. And that's why when I say Kiyosaki, Grant Cardone, Donald Trump, Buffett, all of the big guys, girls that own real estate, they're going to utilize this to their advantage to ultimately what? Like the end of the day, they're going to earn cash flow on the assets. They're going to lose money on paper, which means they're not paying tax on the cash flow right then and there, because they're showing a loss on paper. And the ultimate strategy is, hey, I'm going to find a way to bring these losses over here against my business income to ultimately bring down my tax bill. And let me tell you, to do that, there are a lot of hoops to jump through. And that is why you need to work with someone that understands, all right, I'm going to go into long-term real estate and this is my profession. How do I do this? Oh, I'm going into short-term real estate and neither of us work in real estate. So how do we do this? And so if I had to think of an order of operations, why you should get a cost segregation study. If you have a rental property producing you rental income, I would get a cost segregation to bring down that rental income and to show a loss and have tax-free cash flow. That's number one. I would also get a cost segregation study to, let's say you drive a loss on paper. Cool, you're not going to pay tax on your income because you cash flowed, but what do you do with that loss if you can't use it against your, let's say, W-2 income or your business income? You're just going to roll it forward and use it next year against the rental income that you generate the next year. That's fine. And another benefit would be, let's say you have a loss that you roll forward and you can't use yet. Well, you just end up using it when you sell the property. So let's say you have a $20,000 built up loss and you sell this property for a $100,000 gain. You can use that $20,000 to go against the $100,000 and pay tax on $80,000. So it helps you out later, sort of a delayed gratification. Another step would be, hey, I have a business that I don't really participate in and it kicks me cash flow. Well, I can utilize my rental loss to offset that income. We have tons of clients that do that. And the ultimate approach is what the big guys are doing, where they make their money in their business, they lose money on paper in the real estate, and then they net those two together to ultimately pay no tax or less tax than they otherwise would have. And I know that's a ton of information to dump into a video like this, but that is my take at trying to explain what cost segregations are, why they're important, the different types, and ultimately how they're going to help you when it comes to your specific tax situation. And so when it comes to cost segregation, if you are a real estate investor, make sure that you're working with not only a CPA that can help you navigate who to use, what you need from them, and give you good advice, but also that you use a firm that is trustworthy as well. And so like I said, we'll reference down below some of the firms that we work with. By no means do you have to use them. Try anyone else you want, but it can just give you a gauge as to, who's in the marketplace to help you out. And with that, I know that's a ton of information to drop into a video. What they are, when to do them, how much they are, the different types, who benefits from them. But as always, if you have any questions on something that I maybe didn't cover or you want to know more about, feel free to drop in the comments. That would be much appreciated, and hit that thumbs up button, and I'll see you guys on the next one. Cheers.